customized portfolios for high net worth and institutional clients, in addition to advising client families and officers on varied investment and business related. Walter's career is also his primary hobby. His professional experience includes 21 years with U.S. Bank, 5 years with Reinhold Partners and Madison Investment Advisors. At U.S. Bank Corp, Walter served as the senior portfolio strategist and worked with the largest clients and prospects of the private asset management group across the country. In addition to these responsibilities, Walter spent considerable time as a spokesperson for the bank's private asset management division, delivering investment strategies sessions to clients across the United States. In addition to that, he was the first manager of the first American large cap core fund and the first American balanced fund, and managed 2 model portfolios used by the portfolio managers of the U.S. Bank throughout the United States. Walter, who received his BBA from the University of Wisconsin-Madison, he serves as a director of a number of Wisconsin-based organizations here, and also as shareholders of each of multi-generational families. He and his wife Londa take pride in their long-standing commitment to their Madison and Wisconsin communities. I'm Walter Dewey.
What's the easiest way for me to advance this? Just wave or?
I can switch computers with you if you'd like.
I will just wave at you.
Okay, no worries.
And keep me moving along, because otherwise I can talk all day. I got a huge kick out of listening to your Seinfeld references here earlier about getting lost in parking lots. And one of the things that we're going to include here today is just reference to Judge Reinhold. And of course, Judge Reinhold was the close talker on Seinfeld. So, everything always comes back to, popular culture and Jerry Seinfeld. I'm always gratified coming today and speaking to you folks. I mean, in 2008, I had the opportunity to talk to the South Rotary down at the Sheraton, and it was in the middle of the financial crisis. And at that particular time, it was basically a story of what could go right and why you should think positively about the long term and the opportunities ahead. And you always want to be buying when everybody else is panicking. And now when we have a title such as excessive monetary stimulation in the everything bubble, the inverse of that is probably a wise course of action. Glad you're moving into your new house. You were probably thrilled with how much money you got for your old house. And then you looked at the cost of construction on your new house. And it's basically all tied together from the standpoint of this excessive monetary stimulus that's been taking place for a considerable period of time. And so we just want to go through a little bit of this in some detail, because there is no such thing as a free lunch. We all like to think there is right now. The federal government's been spending an awful lot of money to fight the pandemic. The Federal Reserve is then buying those bonds, so we don't have to buy those bonds. Keeps interest rates low. Lots of money around for everybody. Interest rates are low. Housing has never been more affordable. And then the stock market goes up. What's not to like? Well, starting to see some signs of that from the standpoint of price increases and inflation running at the highest levels of the last 30 years. As I like to tell my kids, if all it took was printing lots of money, we would have all gotten a lot wealthier a long time ago. That's just not the way that this works. So what we'll do today is go through a number of charts just to try and illustrate some of these effects. And if anyone has any questions, just raise your hand and stop me, because otherwise I can go on for a lot longer than anybody probably would care to hear me say it. So the main thing we're going to talk about is both on the economy, how it is performing currently and some of the issues that we might be seeing, how that is dovetailed into inflation, and therefore what the risk might be to financial asset prices. Because that's the main thing is, I like to tell this story that if you're going to forecast, make sure you forecast often if you're guessing where the stock market's going to be going, because it's never going to do what anybody expects it to do. And that goes for all kinds of things in life. 2 years ago, if there was anything that we would have been absolutely sure of was that we were all going to live in urban environments. We're going to ride mass transit. Plastic bags were being banned. And you go forward about 5 or 6 months, and we were all buying groceries from plastic bags. Nobody was riding a bus, and nobody wanted to be in an urban core. And that doesn't mean that, this is the way it's going to be forever. It's just one of those things that be careful about forecasts because they're so often wrong. So if we go to the next chart, what has happened during the course of the last 3 months was the stock market took a breather. And the reason that it took a breather was because of the Delta variant really taking the spotlight. And that has been a great forecaster of where interest rates might be headed. So we're going to go into that in a little bit of detail in a moment. But the main thing we want to emphasize here was during the third quarter, it was the first of this year, the market advanced for the 5th consecutive quarter in terms of the S&P 500. But that wasn't nearly, it was by far the best compared to other indices around the country. And so small and medium-sized companies didn't do quite as well over the course of the last 12 months. And that's looking over here to the second from the right column. Small stocks are up 58.9%. The S&P 500 is up 42%. Just a spectacular period of time for the stock market indices. If you look here at the bottom of the page, bonds were basically down a little bit for taxable bonds, and municipal or tax-exempt bonds were actually up just a touch. But going back over that period that I said to 2008 and the financial crisis, the 10 years ended October of this year. The S&P 500 up 16.2% per year, up 14.4% on smaller companies. Bonds have been returning about 2.5%. It's been an excessively good period of time to be invested in the stock market. And the world just doesn't grow that fast. And so that's where anytime you've had a 10-year period where things have been this good, it doesn't mean that you still can't have good returns going forward. But the idea that they're going to be anywhere close to what expectations are that based upon what's happened over the last 10 years, I think is going to be a tall order. In terms of treasuries and case counts, we wrote in our quarterly letter that the bond market has actually been a better predictor about what's going to be happening with COVID than all of the experts. And you say, well, how is that possible? And what is it that we're speaking to? Well, in the blue lines here, we basically are showing you COVID counts. And then the 10-year treasury yield is up above in gold. And essentially, when you look back, and I think about this as looking back at May, where you had interest rates had been moving up pretty appreciably. And the reason they've been moving up was we had this really good period of good news. The vaccines were being rolled out pretty hard. Case counts had been declining. We were putting the virus in the rearview mirror and getting back to normal. And lo and behold, interest rates started declining. And this was very puzzling to us because it was like, why are rates going down? They should be going higher. Inflation is starting to heat up. The world is going back to normal. The 10-year treasury should go back to something closer to 3% just as an expectation. And it was falling. And what was happening was that the case counts were increasing. And that increase in case counts came from the Delta variant. And that, of course, slowed things down again on a global basis. Now we're starting to move through that. And as a result, better news is coming in regard to the economy, simply because of the fact that we've gone from the pandemic stage and we're moving into a period where we're just going to be living with it. So from a market outlook perspective, we've got a number of different things that we're speaking. One is on the path to the new normal, which is, okay, whatever the new normal is going to be, we're not sure about what that is, but it's certainly going to be post-pandemic. We say the everything bubble is raging on, meaning prices are up across the board for all assets. And what that's come from is, as we said, there's the free money that's been supporting the markets. Challenges are starting to emerge with energy prices that are certainly not acting like inflation is transitory. It's acting like it might be here for a little bit longer. And we're seeing this in input prices across the board. Finally, in terms of the normalization of interest rates, we can sit there and look at interest rates as if they're a coiled spring that they just need to move higher. For those of you in the room, it's like, well, let me see. If inflation was up 6% over the last 12 months, why on earth would I be investing in money market where I've got a yield of 0, where I'm just losing out to what's happening with inflation? And that's basically a case where, as an investor, you start demanding higher interest rates in order to invest in that sort of thing. As we've said, we haven't had to make that determination because the Fed was doing it all. The Fed just decides, all right, this is what we're going to do instead. So in terms of this path to normalization, what we basically are speaking to here is that the vaccination rate is considerably higher now at 66.7%. With kids being vaccinated, that's clearly going to be moving up as well. The net effect is that it's going to be nothing but a positive from the standpoint that if you are vaccinated, you're probably, the breakthrough cases aside, you're probably not going to be hospitalized. And if you're not hospitalized, you're probably not going to die from it. And that's a dramatic difference from where we were just a year ago. At the same time, the core inflation rate has moved up to 4.5%. And one of the other things that we like to speak to is the unintended consequences of the Federal Reserve basically monetizing all of the debt that's been accumulated by federal spending during the pandemic. We're now up to $28.9 trillion of public debt outstanding. Essentially, this is one of those things that, as I like to tell my kids, you can borrow today to consume more today, but that means you're not going to be consuming as much in the future. And unfortunately, what we have right now is with some, what I consider to be cockamamie theories of modern monetary theory, where you can just keep borrowing and spending and borrowing and spending, eventually the compounding starts working against you and you can't. And so that's one of the concerns that we're starting to have, simply from the standpoint the amount of debt outstanding has become quite a problem. The everything bubble raging on, as we spoke to housing, you can see that this big explosion in house prices right after the pandemic first came about, when everybody really wanted to stay at home for a longer period of time, and with interest rates as low as they were, 19% increase in housing prices over the course of the last 12 months. In the Rocky Mountain West, they're up 26%. And I like to say it's pretty easy to tell why they're up 26% in the Rocky Mountain West, because now if you can live in Vail, Colorado and do Zoom calls, geez, I can work from anywhere. And that's one of the things that we saw last winter, was a whole bunch of people that had been in New York. Now they were living in the Rocky Mountain West and bidding up home prices. We also are speaking a little bit to 6,000 cryptocurrencies. How many of you have a Bitcoin account? There you go. All right, now we know who's buying new houses. You can now buy a house with a down payment in Bitcoin, which is kind of an interesting way to do things, because I can't think of anything else you can actually transact with Bitcoin. I've been equating it with Beanie Babies, pet rocks. There's all kinds of things that you'll eventually be able to do with cryptocurrencies. And you hear about, you know, I'll keep saying my kids, but the reality is they'll say, well, you just don't understand. And I say, well, I don't understand because I don't know what you do with it. If it's a stable coin, if it's worth $1, I can understand immediately why you would have blockchain technology would enable avoiding all kinds of different hands at the till that would normally be taking money out and therefore could be displaced. But if it's just trading for the sake of trading, I mean, I just read the other day that somebody with a new crypto that is a spoof on Dogecoin, which was a spoof on Bitcoin in the first place. The guy is now a multi-billionaire. And spoof. So these types of things, that which cannot continue won't. And so it's only a matter of time, but that level of speculation is clearly taking place. In terms of Judge Reinhold's advice, in the movie Ruthless People, Judge Reinhold was a hopelessly nice guy, but was trying to be a bad guy. And he and his wife had wound up kidnapping Bette Midler. And so when he was trying to be a bad guy, he was selling.
That's a bad idea.
Yeah, he was selling a Pacific Stereo, and he was trying to. He was going to maximize the amount of money he could make. And so he had this giant speaker that he was trying to sell to this young kid. And he said, "Isn't this thing cool?" And the kid's like, "Yeah, I want it." And he says, "So what if it's as big as a house and costs as much? You can finance it." And then the guy's wife came in that had a young child, and he said, "Okay, no, let's get the smaller one instead." The point being is that as a society, we are now financing everything. And you're seeing it across the board from the standpoint of what the Federal Reserve has been doing, monetizing the debt. And there's a recent paper that basically was written that suggested that with excess money in the system, for every new dollar going into the stock market, it actually adds about $5 in market value incrementally. So this is just a way of saying lots of money sloshing around, finding its way into the stock market, and that's been taking it up. The double-edged sword is what's been happening with energy prices. And whereas we're not driving as much yet as we were prior to the pandemic, and that is certainly starting to heat up, what you've seen is a major move in oil prices higher, and there's a combination of things going on. One is that it's actively being discouraged because of environmental issues and policies of the administration. The other thing is a lot of oil producers have lost a lot of money for a long period of time. And like every bit of supply and demand, if you haven't been earning a good return, then you're not going to be drilling for as much as you had in the past. And so, unfortunately, you have very long tails. It's not something where you can just go out and drill tomorrow and produce more oil and gas. And this winter is going to be a particularly challenging time. Not nearly as challenging in the United States as it is in Europe. In Europe, you might have been seeing that natural gas prices have exploded. Part of it is that they are dependent upon, the good virtues of one Vladimir Putin, which isn't exactly a place I'd want to put myself in. But the other thing that is a challenge is the fact that they've been shutting down a lot of their traditional carbon-based energy sources. And when you're dependent upon the sun shining and the wind blowing, if you don't have a lot of wind blowing, as they've had in Europe in the course of the summer, they've had some major challenges in regard to their electric supply, and prices have been rising commensurately. So this is one of the equal and opposite reactions of an energy transition and a lack of new supply on the oil side. So don't be surprised if you see higher energy prices, higher oil prices for some time to come. Who is not hiring? This is one of those things that my wife, before I left this morning, she said, "Hey, there's a basketball game at 8 o'clock tonight. Where do you want to go downtown to have dinner before we go?" I said, "Well, the only place that's open is the tornado room, and you won't be able to get in, so we'll do something at home." And that means it's just a reflection of everything is essentially closed downtown because of lack of help on Monday nights. And that's what you're finding everywhere. Who is not hiring? And you see this in terms of the job openings there in gold has exploded because everybody who wants to work can certainly work. And then the labor force participation rate in blue, it has come back up a bit after what we saw during the height of the pandemic, but it has certainly not come back materially yet. A couple of things that are going on there. First of all is that the boomers are all getting older and the boomers are retiring. So there's a lot of folks leaving the workforce. The second thing is that a number of circumstances are such that with rising wages, 10% of the workforce that had been working 2 jobs don't have to anymore. They can work 1 job and be paid pretty well. And so at the margin, that's taken some folks out of it. And then the last thing I guess I'd add is, I grew up in such a way that if I didn't always have money in my checking account, my savings account, investment account, whatever else, I always had to be worried about what would happen on a bad day. I always had to have liquidity around. What seems to be happening is that there's a good chunk of the population that's very content that if there's some money in their checking account, they're good for a week. And there's been a number of programs that have been in place that most folks are fairly liquid right now. They've got cash available to them, and so they don't need to work or they don't want to work. Whatever it happens to be, we've had a major problem with a lot of folks not just running back to the workforce, and as a result, there's supply shortages of labor everywhere. So the net effect is that we've got a little bit of traditional inflation where too many dollars chasing too few goods. So we've got the Federal Reserve, as I said, lots of liquidity, and then the too few goods. We've got issues that have come up in regard to labor. We've had issues that come up in regard to energy, and that's just the classical definition of inflation, and we're starting to see more and more of it in a number of different places. And so, as we say here, prime or not, shipping isn't free. If you wanted to get a container vessel right now, the price has absolutely exploded. Part of that is that there's just too many of them sitting off the Los Angeles harbor. And so the demands for those that are available have certainly gone up. And then if you look down at the amount of activity in terms of shipments, that activity is much higher than it had been during the pandemic, and that's clearly what's driving prices higher as well. So inflation in our minds is still something that's going to be around for some time, and just because things have been really cheap on Amazon, and thank God Amazon was there during the pandemic for the delivery to what we needed to our homes, it's looking increasingly like a lot of those costs are going to start getting passed on to others. So not convinced yet. What we mean by not convinced yet is inflation for real and it's going to be there to impact asset prices, or does the bond market still think that there's not that much of an issue? And where we say that there's not that much of an issue is that if you look on the top chart, it says inflation's running at 6.2% after averaging 2.3% for a considerable period of time. The federal funds rate is basically flat on its back at 0. That's what the Fed can control with short-term interest rates. And then you look at long-term interest rates, the 10-year Treasury at 1.46%. It's currently at about 1.62 as of today, still way below inflation. Now,
A question on inflation. Do you have figures on like a rolling 3-year average rather than just a year to year?
And that's where we'd say that it's been averaging about the 2.3%, but then dipped down during the pandemic, you can see, and then has rocketed up.
The 1 year is compared to, it's using the year in the pandemic.
From a base.
So it's a low base, which makes the 6% artificially high compared to 3 to 5 years.
Correct. And that is where,
is there any other difference, or what other difference makes it high?
What the administration had been speaking to was and they had been using the language of the Fed, which was it was transitory, which means it was taking effect of what you're speaking to, which is just, well, it's a quirk of mathematics, because it had been real low. Now it went back to where it is, and it should be fine from here. And what is now becoming pretty clear in the most recent couple of months, and you've seen it with the Federal Reserve taking away that transitory language, that's what is starting to get people a little bit more concerned, is that it's not just 1 year compared to a cheap base level of a year ago, it's starting to climb on a month-by-month basis. And so that's where the telltale sign will be over the next several months to say, okay, now that we're emerging from that period, I'll say the post vaccine period, year over year, will be more telling. And a lot of the evidence that we're starting to see is that that's going to continue to tick higher.
So what's the months in 21 where the cross, I'm looking at your top chart and I'm having trouble reading some of the numbers.
Yeah, they're quite small.
So but the line in the middle, I take it is.
That's that 2.3% average.
Yeah. But what month are crossed to go above the average?
Looks like it was probably in about February or March of this year.
So until February or March, we're going to be comparing to an artificially low number.
Well, at least and it's a 12 months, so that's going to be carrying where it had been at 2.3% where it crossed over was going to be bringing the prior 12 months in there as well.
Oh, okay. So it's a rolling.
So it's going to be rolling up. But the main thing that we basically say is, okay, even if we believe that inflation is going to return to a 2.3% level, the challenge we have in terms of what's going on with the bond market is it's still only 1.62%. So it's one of those, all right, if I'm going to invest in bonds, I got to at least earn 2.3 just to break even.
You're almost guaranteed to lose.
Or I'm just guaranteed losing money.
Yeah.
You know, and that's we can argue about how many angels can dance on the head of the pin as to what the real inflation rate is. But the main thing is that it's something greater than 2.3 at this point in time. And we've got pretty good, belief that it's going to be remaining above that level.
So I'm going to want to look at February or March and see what the figures are then. If it's still
see on the trailing 12.
Yeah.
I'm as I said, try and buy a car right now. Used car prices are up 26% year over year. Because you can't get a new car, and everybody wants a car. Because as I said, things.
They're not going out to eat, so.
And they're not going out to eat. What do you even need a car for?
We're going to work, right?
Yeah.
Walter, just really quick, just had a conversation with a neighbor. He had a 2000 Chevy Silverado high-end truck. He's 75. It's just he paid $42,000 for it about a year and a half ago. Simmed 42,000. Simmed, he's got about 6,000 miles on it. Okay, he doesn't drive it very much. Simmed in Mount Horeb, he paid 42, gave him 49,000 for it, and wrote him a check. He was at the dealership 15 minutes. Wrote him a check. Why? Like you said, try to buy a new car. Well, that's a used car. It's a truck. It's just supply and demand.
It's supply and demand. It's the
$7,000 on a used truck.
Too many dollars chasing too few goods. I mean, that's the classical definition. And we've had a 30-year period of time. The other questions we ask is, okay, look at what's been happening with our relationships with China. I mean, if there's anything over the last 30 years we're absolutely sure of is that they're going to export cheap, high quality finished goods to us. The old story of the iPhone. I mean, the computer that is in our pocket, vastly more powerful than anything the IBM mainframes ever had. And they arrive year after year, higher quality at the same price. Part of that's just wonderful invention and the way that things have continued to move on. Another part is just the fact that we've had a cheap source of labor in another part of the world for an extended period of time. Is that going to continue as easily as it has, given the fact that what's going on in terms of relations between the countries? It's a great question. I don't have the answer for it. We compile the weight of the evidence and say we might be in for a period where inflation's higher, and we don't think the bond market has taken account of that. And interest rates moving up, it's just a basic function of what's the cash flow that we're receiving divided by what's the discount rate. And that discount rate is going to be driven by treasuries. You look at housing prices, you look at demand for trucks, whatever it happens to be. The first question is always the Judge Reinhold, what's the payment? That payment is lower because interest rates are lower. And if that was to move higher with interest rates, then that's where some of the challenges might come. So the story on all of investment is anticipating where those changes might come that the consensus isn't seeing. And when I look around and as I say, in 2008, I can come out and I can try and talk about all the opportunities out there because the world looks like it's ending. you know, from the standpoint of the financial crisis at that time. And now I'm simply trying to say, boy, we've had a great period of time. There's a lot of stimulus that's been built into it, and now we're a little bit more concerned. The next thing I basically speak to is growth or value. What is more appropriate at this point in time? Growth stocks, just think about the fan mags. Everybody's heard the expression about the fan mags with Facebook. Well, I guess it's not Facebook anymore. So we're going to change our name because we've been getting some bad press. But Apple and Amazon and Google and Netflix, I mean, these are all companies that have really driven the market for the last decade. Multi-trillion-dollar companies. If you didn't have those companies within your portfolio, that's what's really driven the S&P 500. And when we were speaking earlier about the fact that the bond market was predicting where the pandemic was going to go, the minute those interest rates started going down because there were questions about the economic viability of the recovery because of COVID, what happened? But those giant companies started reasserting themselves. And so what we basically say now is that with normalization coming, interest rates moving higher to reflect that inflationary pressure we're speaking to, we would rather be in smaller to medium-sized companies, economically sensitive companies, not just the fan mags. Microsoft right now is trading at 36 times estimated earnings over the next 12 months. And it's a multi-trillion-dollar company. It's been growing very rapidly with cloud computing and this sort of thing. We basically say, hey, it can continue to grow nicely. We have no problem with that. But let's just say that Microsoft went to trading at 20 times earnings, which would still be a pretty good valuation for most of my career, and I'm 61 now. You know, you can just do the math of 20 divided by 36 is a meaningful decline. And we're not predicting that the world's going to end for Microsoft. We just rather look for things that are much cheaper, that it's going to be more difficult for those types of companies to move forward from that size and those valuations. So the conclusions is we're looking for a change in Fed policy right now, and we didn't go into a lot of discussion about it, but the Fed is now talking about tapering their asset purchases. And what the Fed basically means by that is, normally speaking, we think about the Fed controlling short-term interest rates, which is what we are going to be paid for investing in money market. That's what the Fed controls, those short-term rates. Long-term rates are left to investors. They're left to you and I to go and buy those treasury bonds or to buy corporate debt in the market itself. During the pandemic, the Fed has said, yeah, we're not going to do that anymore. We're going to control everything. We're just going to smash the yield curve down all over the place. And so they've been buying bonds for their own portfolio. And now instead of spending 1.2, you know, what's that, $120 billion a month. So literally about $1.5 trillion a year that the Fed is buying in bonds that we don't have to. They're now saying we're going to start slowing the rate that we buy those bonds. And that means someone else is going to have to buy them. And that means that those longer term interest rates should start moving up theoretically, just in terms of supply and demand. And so that's the first thing, just from the standpoint of the tapering of rates. Predicting the timing, as I said, always a challenge and highly unlikely to be right. So if you're going to forecast often. Economic policy transitions can often lead to increased market volatility. Could anyone tell me what's going to be in the Build Back Better bill and if it has a chance of passing? No, nobody knows nothing. This is another one of those, we're going to have to pass it to find out what's in it. And that was actually a quote from the speaker, if you remember, a number of years ago. That's just rife for opportunities to people say, oh my goodness, if this thing passes, what's actually in it? That could be a surprise, both positive and negative. Different than the financial crisis, this time consumers are in great shape financially, but governments are in trouble. 13 years ago, it was the exact opposite. All kinds of folks were out over their skis in terms of borrowing too much with their house and that sort of thing. The government could step in because the government had much lower levels of debt. Now we've basically used a lot of that up. So it's going to be up to the consumers to do a lot more in this particular expansion. We continue to trim equity positions just because long-term objectives are really important on the investment markets. You don't want to start rationalizing going to higher and higher allocations, and that's what we've been talking about with the portfolio for your foundation. Position portfolios towards companies and asset classes that are lower in terms of their market capitalization, more economically sensitive. And then given the inflation outlook, we still think bonds are terrible investments. You want to keep maturities there very, very short. Because if interest rates were to move up appreciably, a lot of longer term bond investors are probably going to be very disappointed with the returns that they might earn or how much they could potentially lose. Government bonds right now, if you have a 20-year government bond, just as an example, the duration on that, if we just guess with such low interest rates, say it's 17, it's a measure of cash flows, but if rates were to move up by 1%, you'd lose 17% of the value on that government bond. And so the market risk right now in longer term debt is very, very high. And so we think that's a reason for concern as well. And then lots of disclosures because you all have to be protected from financial types like us. That's where we always include those. But again, thank you for the opportunity just to give you our 2 cents worth. The main thing that we want to leave you with is it's been a remarkably interesting period with a global pandemic. And I say interesting simply from the standpoint that it really disrupted the way that the expectations were of what the future might be. Therefore, stay flexible. But from a monetary perspective, all of this free money that's been out there for an extended period of time and has inflated asset prices in a lot of different places, we'd simply say be careful because rising interest rates is going to change everything. It's just a matter of when they come. Yes.
Can you just give us a little quick summary of how our foundation investments are going?
It is currently invested upwards of about 64% in stocks, I want to say. So we've let it drift a little higher, but that's where we're looking to cut it back. And it's probably up somewhere in the neighborhood of about 13 to 14% year to date. And that comes from the bonds doing absolutely nothing and the stocks being up considerably. So it's been a very good period for long duration assets, as we like to say, but we don't want to overstay our welcome by rationalizing, oh, let's just let that keep going. And trends go to extremes, they last longer than you expect, but we want to make sure we're always taking some chips off the table.
Thank you.
Sure. Yes.
So you had mentioned earlier talking about labor and different people, different groups fading out. One I've heard is that there are a number of people who are out of the market because they're staying home. They're because of the pandemic reasons, and maybe it's a stay-home parent or something. One of the spouses is staying home, and they're still on the sidelines. And what have you heard about that part of the market coming back, or maybe is more of a permanent change kind of going forward?
It's a great point. This is. Nobody recognized how important the schools were to childcare and how disruptive that was and how challenging it was for parents with kids. It's like, well, school's not in. I mean, here, I gotta be assisting and teaching them and everything else. If there's anything that we saw from the financial crisis as well as from the shutdown with the pandemic is getting away from work or being laid off or facing those challenges happens very, very quickly. It's just slower to come back. And so I'm hesitant to say that there's anything permanent to it because there's all kinds of other, we've seen it with parents being at home and seeing what kids are being taught and everything and the reactions of various folks. So there's going to be all kinds of changes that might be coming. I know for our own firm, we're here downtown and we're all in the office now. One member of our team has 3 kids and he still works from home pretty extensively because 1, he enjoys it, and 2, he has that need. I think employers are just going to be much more flexible in those types of circumstances with talented people. But like everything else, if you've got a unique skill set, you're going to have a lot more bargaining flexibility with your employer than somebody who wants everybody together in one place. Because I'm very wary of just saying, oh, we're all just going to be remote, because then you just turn into a rate. You're not a part of a service club. You're not a part of a community in your office. Yes.
We have an online question. How is solar and new energy doing and done during the pandemic?
Solar and new energy has done spectacularly well during the pandemic because all things that are new have been richly rewarded by investors because they've had time to be at home. And there's been a number of, they're referred to as meme stocks or story stocks. We heard about it with GameStop here a year ago or earlier this year was a big story. But the main thing I'd say is companies that are just getting started, where investors haven't been able to pin down what their sales are, what their earnings are. It's more, hey, the future is going to be very, very bright. Investors have been able to bid up those prices dramatically compared to old standbys that everyone can identify. Tesla as an example. Who doesn't love Tesla? Up 45% last month, $345 billion in incremental market value because they got a contract, or the rumor of a contract with a company that when the pandemic started was a bankrupt rental company. I mean, it's kind of remarkable, but it led to a pretty dramatic outcome. So I say that as the example simply from the standpoint that rising interest rates and then having to show earnings is going to be the next step for a lot of these companies that have had great returns during the pandemic. Yes.
What about the lack of energy in California and the problems with solar?
Lack of energy in California is California doesn't produce a lot of their own electrical energy, and as a result, electric rates are very, very high there. My daughter got married in California this year, so my wife and I went up to Big Sur after the wedding. I had the privilege of paying $6.50 for a gallon of gas. Welcome to your future. So California, it's both the best of times and the worst of times. The sun shines there, which is a really good thing, simply because of the fact that that's where solar should be located because of the fact they have so much sunshine. The challenge they have is it's a massive economy with massive energy needs. And they have been, they've been very optimistic about what they can get from new energy sources. And as a result, there's a lot of brownouts that have been occurring during hot days in the summer in California because they don't have base load generating capacity. And this is going to be the interesting challenge for all of us as we go. We're trying to do something very rapidly that used to take place at the margin a little bit at a time. And a good buddy of mine who used to work for a public utility, who's a very knowledgeable engineer, he just put his own generator into his house here a few weeks ago. And the reason he did that is he said, yeah, we're getting rid of our base load capacity at the margin. When you have real high demand days, I don't want to be getting shut off with some of these rolling brownouts like California has experienced. So again, moving to a greener future is something that is currently the trend. But the base load that we've all sort of taken for granted is something that we also have to make sure is there so that we don't experience some of those challenges like California. If nothing else, thank you very much.
All right, thank you, Walter. Thanks for that update. And next week, our speaker again?
Elizabeth Najir, who will be discussing her experience as a Rotary Peace Fellow in Kenya.
Oh, cool.
Awesome, very cool. Well, hope to see everybody next week. Thanks.
It's very interesting.